Hello, and welcome to this week's BNP Paribas Asset Management Talking Heads podcast. Every week, Talking Heads will bring you in-depth insights and analysis on the topics that really matter to investors. In this episode, we'll be discussing absolute return fixed income investing. I'm Andy Craig, co-head of the Investment Insight Centre, and I'm joined today by James McAlevey, who's head of Global Aggregate and Absolute Return in our Global Fixed Income team. James has managed the team for 4 years now, and he and his team have recently celebrated their global bond absolute return strategy, passing the milestone of 1 billion euros of assets under management. Welcome, James. Congratulations, and thank you for joining me today.
Thank you. Pleasure to be here.
Right. Let's get down to work. To begin with, perhaps it's good if we just set the scene to make sure we're clear about what we're talking about. Absolute return, in contrast to traditional long-only bond strategies, is managed against a cash benchmark rather than a benchmark that reflects the composition of a particular segment of the bond market. Secondly, you and your team have freedom to roam, meaning that you're not constrained to one particular segment of the bond market, to the corporate bond market or the sovereign bond market or a particular sector of global bonds. You can invest across the global bond market without constraints, and the aim is to generate positive returns regardless of what's happening in the broader market, regardless of whether interest rates are rising or falling, whether corporate bond spreads are narrowing or widening. The object is to generate positive returns, whatever the overall environment is. And your strategy aims to deliver an excess return of 2 to 3% over cash for a low volatility between 2 and 5%. So, having established the framework of what you do, it would perhaps be good to begin with if you could talk us through where the interest from investors in your strategy is coming from. What's the sort of profile of investors who are including an absolute return bond strategy in their fixed income allocation today?
I think if we take just a very brief step back, you've done a great job of articulating the flexibility of these sort of strategies generally provide. And indeed they do. They provide a lot of flexibility. And I think for some that creates a little bit of headache, as it were, in terms of where to put this type of strategy in their own portfolios. When I conceived this strategy and joined BNP to establish the process that supports it, I was minded by a couple of things. The first of which is that we have an incredibly well-resourced and very large fixed income footprint here at BNP. And I think it's really important that we can and do wear our traditional fixed income investor hats to try and find the best bonds, the best markets, the best risk-adjusted return opportunities across the entire depth and breadth of the fixed income platforms. And that does sound a little bit more traditional and long-only in nature, which it is, but there is significant flexibility in terms of where we go and why. But the other point, which I think is really interesting, which is why it probably creates a little bit of uncertainty for people in terms of where to put it and how to own it, is this idea of alpha generation that sits alongside of it. And by alpha generation in the context of absolute returns, we mean long-short strategies, market neutral, or indeed outright short strategies, as you telegraphed earlier. And of course, that has real benefits. It means you can and should be able to perform in markets that are not so positive to just long-only mindsets. And that is what I think really truly sets them apart. And actually, that's what really truly sets them apart in terms of where people own them and how they think about using them. I definitely see an abundance of people willing and happy to put this in their alternatives bucket, which is effectively their defensive part of their allocations. But perhaps the really interesting and the more interesting one that we're having an awful lot more conversation on today is the user case from people and individuals that have been sat in money market funds for a number of years now. If we cast our mind back only a year or two, these investors were getting close to 4% in Europe risk-free. That is now no longer the case. And that 4% is now 2%, crudely speaking. And investors kind of want to get 4% again. They sort of want to go back towards that 4% type number for a fixed income portfolio and allocation, but they want to do it without 7 years of duration. And they want to do it without going all the way down the risk spectrum as it relates to corporate credit. That obviously has inherent risks attached to it, particularly at this level of spreads, I would argue. But yeah, it's that user case, which is as a cash surrogate, if you will, or a cash enhancement, where because we also focus on the capital preservation objective as well as just the upside capture, I think it gives people a lot of comfort that there isn't a 10 or 20% drawdown on the horizon. And we do everything we can to limit that 12-month drawdown to a number no greater than 2.5%. So a clear variety of user cases here. And a couple of the most important ones today are very different from the way that I originally conceived the strategy, but it's a function of the circumstance and the environment we face today with declining cash rates everywhere again.
Perhaps you can talk us through your current positioning and give us some color on the fixed income assets that you like and those that you dislike. Because, of course, you have flexibility, and that allows you to generally go overweight or underweight the risk of these assets using derivative strategies. That means you can potentially benefit from rising or falling markets. You can protect against downside risk. You can position for a widening or a falling of risk premia on, for example, corporate debt. You have a lot of flexibility and a certain symmetry in terms of how you can manage. So perhaps you could talk us through the positions you're currently running and what you particularly like and dislike in fixed income.
Absolutely, we can. And just to be clear, historically around this sort of strategy, we would have been short duration back in 2022, which was a very strong rising rate backdrop for markets. And that enabled us to deliver positive performance in a year like 2022. But sitting here today, we are absolutely not short duration. We are a long duration. We can come on to talk about that in a moment. But in terms of where the best risk-adjusted returns are globally, we only allocate capital where we deemed we are being adequately compensated for the risks that we're taking. Now, that's a relatively high bar at times, which might mean that for the majority of the environments, we're not actually fully invested and we lean on the alpha generation more. And at the moment, we're not fully invested at all. Maybe we're about 50% invested, and we can find some things to do that offer really good, credible, potential risk-adjusted returns. But what we're not doing at the moment is buying corporate credit. I think some people tend to be a little bit surprised by that. I think they also tend to jump to the conclusion that I might be telegraphing a big recession around the corner or a big default cycle that's going to result in meaningfully negative returns for these asset classes. But we're not. That's not the view. That's not necessarily what we expect. But with a bar that says only allocate capital where you're being adequately rewarded for the risks that you're taking, we look at spreads as tight as they are today, and I think in spread terms, not total return terms often. When I look at spreads where they're trading today, there's not a lot of protection in there for something to go wrong in the future. And we like protection, and we like additional potential gains and income and potential capital returns in terms of spread compression. And none of that exists in the corporate credit landscape today. So I think it's an interesting topic, and I know that some people are generally a little bit surprised when I tell them that we are not at all interested in corporate credit at this point. But that's the reason. The bar's quite high and the compensation at the moment is very low. And also, let's remember, there are quite a lot of risks out there on the horizon. I know everything looks hunky-dory at the moment and volatility is low everywhere and risk assets continue their ascendancy to ever higher and lofty levels. But when you're not being compensated, I think you have to draw a pretty firm line in the sand. And that is what we have done with corporate credit of late. The other reason we're not actively involved is that we can find other things to do that do look attractive, where spreads are a lot wider, where we do believe we're being adequately compensated for the risks that we're taking. At the top of that list is an allocation to US mortgage-backed securities. These are the government-backed agencies of Ginnie, Fannie, and Freddie. And these have never really experienced any defaults historically, even through the GFC. That was all a subprime issue and a non-agency issue. But today, those spreads are wide. They're quite wide versus history. Volatility in fixed income is elevated, and this asset class tends to cheapen when volatility is high and tends to richen when it's low. And because we're in a higher fixed income volatility regime today, the opportunities in this asset class look quite high. The biggest risk, of course, for these assets would be one of increased prepayments, whereas bondholders, we end up getting our money back a lot quicker in an environment where we generally don't want it. And that's what we call prepayment risk. What we believe at the moment is that the risk of a prepayment wave is incredibly low indeed. So it's a really interesting opportunity. And in actual fact, spreads in the mortgage market are in the current coupons. These are like the newly issued mortgages effectively. Yields there are greater than they are in the US investment grade landscape. Yet these bonds are clearly comfortably several notches up in quality on the credit rating spectrum. So I think it's, again, a nice demonstration that even with a high bar, there's plenty of things that we can find that make sense today. Lastly, I'll touch on it super briefly. Local emerging markets, Latin America in particular, and within Latin America, 2 countries that stand out to us better than any other, and that's Colombia and Brazil. We generally like the asset class. We're favorably inclined toward the local emerging markets. But when we look under the hood, there are 2, maybe even 3 markets that we think offer very credible opportunities. So you find us invested in these markets, but definitely not everything.
Very good. Well, listen, just to round off our conversation, let's take a step back and perhaps you could talk to us a little bit about your outlook for bond markets. I mean, I know you don't obviously have a crystal ball, but what do you see as the big trends and the factors that are likely to weigh on bond markets through the rest of 2025 and into 2026?
First of all, I'm glad you mentioned the crystal ball because you're right, we don't have one, nor does a proposition like this rely on our ability to perfectly predict the future because we are going to be wrong. We don't quite know yet when, where and how or why. But I think it's not lost on anyone that with global policy making as fluid as it is today, that making any forecast on any investment horizon with any certainty is open to fairly regular disappointment. So we don't have a crystal ball, but that doesn't mean that we can't make some reasonably informed statements about what is happening to the asset class. Statements and belief systems, I guess, that help instruct the way that we either A, like to approach investing, or B, think about how we want to construct the portfolio. And I think the most interesting and topical of these today has to surround the ongoing, gradual, but clear trend-like steepening in yield curves globally, for that matter. I know there are some markets out there that are steepening more quickly than others, but over the last 2 to 3 years, and particularly since the aftermath of COVID, lots of yield curves globally have been steepening gradually. Policy rates have been coming down for sure, which always helps the steepening. But this whole issue of term premium rebuild has got the market's attention. Deficit funding, finally, within the fixed income market space is alive and well, and it's absolutely on investors' minds. Barely a day or a week goes by where this isn't a topic for discussion in bond markets. And we saw the extent to which this was relevant in Japan as the long edge of Japan sold off again with now a new leader in charge that is more fiscally open-minded. So these issues are not going away in a hurry. And I think for us, we're operating in a landscape that means fixed income yield curves should be steeper. They're likely to stay steeper than we've been used to in the last number of years. And that's going to come with increased levels of volatility too. The single biggest change that's taken place in the last few years in fixed income markets is this idea that I think for the first time in my career, in fact, fixed income markets are now standing on their own 2 feet. They're now being intermediated by price-sensitive investors only. The central banks have gone, whether it's direct intervention through QE or indirect intervention through global reserve growth through the noughties. There was and has been for the last 20 plus years a very firm hand from price-insensitive central banks. And that is gone. That's dried up. The world looks different now. And fixed income markets are having to digest information. And it's price-sensitive investors like us who are ultimately going to become the marginal price maker in these markets. For me, the punchline of all of this development and evolution is that volatility is back as well. It's back in a structural way. And I don't mean heightened extreme levels like we saw in COVID or the GFC, but the compressed levels of volatility we saw around those fixed income asset classes is going to be a thing of the past. And I think that's a good thing because we are, after all, active managers. We are looking to benefit from dislocations that accrue in the markets. And with more volatility comes more dispersion, more dislocations and alpha opportunities, long-short strategies. So I think all of these developments and structural changes, again, play into the hands of looking and searching for robust, repeatable, active management processes, and in particular, absolute return strategies that can be well placed to take advantage of both long and short positions as that volatility presents itself.
Yeah, you have that symmetry, the flexibility to not just position for falling interest rates, but also for rising interest rates or widening credit spreads, which clearly for an active manager in a market which is driven by price-sensitive investors would seem to be a major advantage. James, thanks very much for joining me today and talking us through the absolute return bond strategy.
Pleasure to be here. Thank you very much for your time.
That's it for this week's episode of Talking Heads. If you'd like to learn more about our investment insights, please reach out to your BNP Paribas Asset Management contact or check out Viewpoint, our website for investment insights at viewpoint.bnpparibas-am.com. We recommend subscribing to Talking Heads on your favourite podcast channels such as YouTube or Spotify. You'll receive your podcast episodes every week. And if you like Talking Heads, please leave us a positive review and a nice rating. You've been listening to the BNP Paribas Asset Management Talking Heads podcast with me, Andy Craig, and James McAlevey, Head of Global Aggregate and Absolute Return in our Global Fixed Income team. Please do join us again next week. Until then, take care.
This presentation includes a discussion on current market events and is not intended as investment advice or an offer of products or services by BNP Paribas Asset Management. Please keep in mind that the information and analysis in this presentation is only current as of the publication date.